Hello and welcome to episode 228 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leeks. Damien, how you doing?
Well, if I'd said how I'm doing, Andy, you'd have had to bleep this first part of the show because normally I'd like to think I'm fairly upbeat.
Yeah, you normally come up with I'm fine, looking forward, life is good.
Normally the same thing we talk about, but I'm not. I'm not in a good place.
I can sense that.
This week. It's a story that might unravel and we might end up on the podcast, but let's just summarise it that in the last 24 hours, being a victim of fraud is not unusual. These things happen. There's not much you can do about it sometimes. But I've been a victim of fraud to the point where somebody's actually managed to empty my children's savings account. So you can imagine that I'm not best pleased,
no.
But I spotted it almost as it happened. So that was fortunate. But it's a long story which no doubt going to come back onto the podcast, even if it's just the learnings or just to tell people how to unraveling this saga. But it's ridiculous to the extreme. I'm not just talking about people taking money out of a wall. I'm talking about somebody going into a branch of a bank and withdrawing money, which we're trying to obviously work out how that was possible, that somebody went into a branch and managed to empty children's savings accounts. Bearing in mind that children's savings accounts are normally accounts that don't come with PIN numbers and cards and all that kind of stuff. So it's probably a story that's going to run because there's a lot of stuff going on. I've wasted the best part of about 5 hours on this so far in the last 24 hours. So if you are an 80/20 investor member, I will apologise because you were due to get a research piece this week, and trying to unravel this has caused me to be slightly sidetracked. But nonetheless, if nothing else, Andy, we're going to have an interesting podcast episode out of it in the future. So
it is very raw, and I can see. Do you know what? You're the same old Damien, but it's horrible to see a friend go through that kind of thing. And it's just a reminder. We talk about frauds and scams and everything on these podcasts, and it just brings those kind of things home. So be vigilant, and like you say, that story will probably run.
Yeah, and it's one of those things that happens to anyone. It doesn't matter how vigilant you are. That things happen all the time and there's not much you can do about it. So, what is on the podcast this week? That's what you're going to ask me, wasn't it?
It was, yeah. Yeah, so let's get on to some more positive news. Let's move on to what's coming up on the pod. What have we got coming up?
Right. After last week's show, we talked about low earnings and the tax relief. I actually got a number of questions about how much you can put into pensions, how the pension annual allowance works, because there's a lot of confusion around it, and I can understand it. So I'm going to do a whole section on the pension annual allowance, how much you can put into a pension. There's lots of rules and caveats. At the crux, it's fairly simple, but it goes on. So I'm going to explain that. There's another piece I want to do on a service I used. I was shopping around for home insurance in the last week or so, and it's one of those things, it's a headache, like travel insurance, like all those things. How do you compare policies? How do you find out if they're good ones? We do checklists every now and then, but there's a very simple way that you can just get an overview of if a policy is any good. And the final piece I'm going to touch upon is a list of bad financial habits for DIY investors that I saw in one of the newspapers this week, and I'm going to pick up on because I don't agree with all of it, and there's some others that we've done in the past on this, and I want to bring them back to the fore on things, if you're a DIY investor, that you should be wary of.
Good stuff. So should we start with the pension allowance piece?
Let's do it. The pension allowance. So I'm often asked, how much can I put into my pension a year? And it's not as straightforward as people would hope. So at the crux of it, what you can put into a pension. So I'm talking about your bog standard defined contribution pot, your SIP or personal pension, or indeed your company pension. Now, the rule is you can put in the greater of a gross contribution of £3,600 a year. So we're basing this around tax years, and the greater of that or 100% of your earnings, all subject to something called the annual allowance. Now, the annual allowance for most people is £40,000. So that means if you run through that in your head, even if you don't earn any money, you can put in £3,600 gross into a pension. And that, obviously you get that's the gross contribution. So there's tax relief on that. So it works out to 2,880, I think the number is, if you take off the 20% tax relief. So what happens is that's why spouses can put in money into each other's pensions. So let's say you have a wife who works and the husband doesn't, then the wife could put some money into that pension for her husband, even if he doesn't earn anything. And they would be the tax relief, the basic rate tax relief. So a lot of people don't realise that. And when I used to work in the city, a lot of very rich clients used to do that for their spouses, for their children, purely to get the tax relief. And it wasn't so much that they were doing the right thing by their other halves. So the current annual allowance is £40,000. Now that has changed over time. It's been £40,000 since 2014. Prior to that, it was £50,000, so that was between 2011 and 2014. But years ago, so back in 2010, the annual allowance was £255,000. Now you might be sitting there thinking, did people actually put £255,000 into a pension in a given year? And the answer, believe it or not, is yes, they did. And I remember when we used to give advice to these rich lawyers out there, and I said it before on the show, if you think the fat cats have all the money, go and look at the rich lawyers out there and find out how much they're earning. I mean, they were having salaries of £1.5 million. They would come in and just write a cheque on the last day of the tax year for £255,000 for a pension contribution. Well, they'd write a cheque for the net amount. But yeah, basically they would pump their pensions with that sort of money. And that was the problem, that putting in that sort of sums of money was really meaning that the tax relief was being enjoyed by the richest people. The greater burden on the government was really a sweetener for the very wealthy. So that's why it got curtailed and was down to £40,000. So what counts towards your pension annual allowance? It's basically any contribution you make or your employer makes or third parties. So if you made 10 grand contribution into your pension and your employer made 30, that's your annual allowance made up. Third parties, obviously that's talking about, like I said before, spouses or anything like that. But anything over that amount, and this is the key part that people don't realise, that if you can physically put more money into a pension than the annual allowance. You can do that. Why you do that, I don't know, because the annual allowance, it really defines the amount you get the tax relief on. So that's why you would do it. So up to £40,000, that's where you would get that tax relief. If you go over that, what happens, you actually get an annual allowance charge. I'm not going to go into how that's calculated, slightly convoluted, but what it does is you get a penalty that you end up having to pay via your self-assessment, which nullifies any tax benefit you had from paying a contribution into your pension that you weren't entitled to. So some of you may be listening to this thinking, right, that £40,000, is that gross or net? That is gross. So that's the gross contribution that we're talking about. Now, you may be with me at this point and think, well, that's pretty straightforward. The problem is that the annual allowance then gets tapered for different people. So for most of us, it will be that greater of £3,600 gross or 100% of your earnings capped at the £40,000 limit. But for some people, they start to taper it. Now, if you have an adjusted income, and now you might be thinking, that's a bit of an odd word. Why did he say adjusted? Now, adjusted income is different to a general income definition. But if you have an adjusted income of over £150,000, then your annual allowance, the amount you can put into a pension, starts to get tapered. So the adjusted income definition is things like your salary, dividends, rental income, savings, interest and employer contributions. Take all that into the round. If that's bigger than £150,000, then for every £2 of adjusted income over £150,000 and between £210,000, you lose £1 of your allowance. Now, don't worry about it. I'm going to just chuck some numbers out here to give you an example. So if you earned £150,000 of adjusted income, you still got a 40 grand personal allowance. If you had £170,000, then your personal allowance drops to £30,000. If you keep doing those numbers, by the time you get to £200,000, you've only got a 15 grand annual allowance. By the time you get to £210,000 total adjusted income, and there are people out there who earn that sort of money, then they've only got a 10 grand personal annual allowance for a pension. So it starts to get tapered. So you may be thinking, well, they're the people out there who are rich. That isn't me. But there is another time where you can have your annual pension allowance tapered as well. And that is if you've started to draw money from a defined contribution pension. So let's say you've got a SIP or you've got a pension that you've actually taken tax-free cash from. So you've started to take some money from, and you then start to draw an income from that. Then your annual allowance is tapered, and it only applies if you actually start to take the income as well. So if you just take the tax-free cash and you move the rest of your money into a drawdown policy, but you don't take any income, then this doesn't apply to you. Equally, if you're drawing from a final salary scheme, this doesn't apply to you. But if you are drawing an income from a money purchase scheme or a defined contribution scheme, then your annual allowance is 100% of your earnings or $4,000, whichever is lower. So it does mean that you can be in a quirk. Let's say that you were working for a company and you were drawing on your final salary scheme, but you continue to work, which can happen, and you could coincidentally be auto-enrolled again into their company scheme, so their defined contribution scheme, then it is possible that you can keep paying into a pension. In that instance, you won't be hit by the reduced annual allowance that I'm describing here. You could actually keep putting in more money, which would be fab. But even if you had drawn from a defined contribution scheme, then you still could pay into a pension, but with this $4,000 limit. Now, the reason why it's reduced is you have to imagine that if you had taken money from a pension, so you took your tax-free cash, then if you were still working, then you could get to a point where you could take that tax-free cash and put it into a new pension and get tax relief. And then you could do the same again where you draw on that pension, take some tax-free cash and then put it into another pension. And you can see this recycling could occur where you just basically keep claiming back tax relief on a diminishing amount of money. So that's why they created this tapering allowance, to try and limit people and stop them from doing that. Because before, people would just use this as a financial planning tool, and financial advisors would do it, where they would actually use a recycling mechanism in days gone by, which was perfectly acceptable because it was within the rules. But this is to limit that. So that's why you have this tapered allowance. Now, one thing I'm going to add is that you can't use carry forward rules, which I'm going to go on to, if you're hit by this tapered allowance, because you can't just go, oh, do you know what, I'm going to use unused allowances from previous years. So you can't do that. Now, carry forward is a rule where you could bring forward unused annual pension allowances from previous tax years. So let's just say we're in this year and you wanted to put more than $40,000 into a pension and you hadn't put money in previous years. So you could carry forward from 3 years and actually put in more than $40,000. Now, there's 2 conditions that you can do that. You've got to earn at least the amount you're trying to carry forward, unless it's your employer making the contribution. And you had to be a member of a pension scheme, a registered pension scheme in the UK for the tax years you want to carry forward from. So it can't be just that one day you decide, right, I'm going to start saving into a pension. I've never done it before and I'm going to carry forward unused allowances. The rules say you had to be in a scheme at that point, even if you weren't paying into it. Now, one final thing before we wrap this section up is final salary. I know there'll be people probably thinking about final salary. Well, how does that work with regard to the annual allowance? And the way that your annual allowance is calculated, how much you've used up, is they work out the value of your pension, say at the start of a tax year, they times it by a number, 16, and they add in a lump sum entitlements and any increases for inflation, and they take away from what was at the end. So actually it's the other way around. They take what you got at the end from what you had at the beginning of a year, and they work out how much your allowance that you've used. So even though you're in a final salary scheme and you may not have paid into, say, a defined contribution scheme, you are using some of your annual allowance, and that will be by the increase in benefits. Because if you think about it, with a defined contribution scheme, if you pay money in, you're increasing the pot size that's going to pay for your retirement. Likewise, with a final salary scheme, throughout that year, that amount that's going to be obviously notionally paying for your retirement is increasing. So there is a calculation, if you're in a final salary scheme, that you have to be aware of, and you can Google it, that uses up some of your annual allowance, because you may want to pay into a SIP, for example, even though you've got a final salary scheme, but you need to be mindful that you don't breach the annual allowance, otherwise you're going to end up having to pay that tax charge that I talked about earlier. So that's it for the annual allowance. I hope I've made that wonderfully clear. But if you want to find out a bit more about it, then you can probably find it on the Money to the Masses website, or go onto the Money Advice Service, because they've got some information about it on there. But before we head on to the next piece, Andy, I just want to remind everybody to do their Money MOT. Now, if you're new to this podcast, then if you haven't done Damien's Money MOT, you can Google Damien's Money MOT or even Money MOT and you will find it. The MOT was designed to be able to sort your finances in a couple of minutes. What it does is, if you go on, there's 12 questions, you answer them, don't give any details, you don't have to register, and you'll get given a score, which is a rating for how your finances stack up. You then can compare yourself with everybody else in the UK in your same sort of circumstances and situation, and then you can register to get a plan of how to improve every area of your finances, including things like retirement, pensions, bills, wills, you name it, it's on there. More than 8,000 people have actually done the MOT. As I say, it's free. You don't have to register to get a score and see how you're doing. It works just like when you take your car to get an MOT. It makes sure your finances are roadworthy, and more importantly, it's bespoke to you, so your circumstances. So if you're a student, you can get a better score than a millionaire lawyer. because it's based upon what you're doing with your money and your circumstances. So go and have a quick go. It's only take 2 minutes. By the time you've listened to this advert, you could have had an MOT makeover and sign up to the email series. And one quick thing on the email series, you can choose to have it weekly or daily.
Good stuff. So what are we moving on to?
Insurances, products. Now, every year I go through that game of trying to get the best deal on my home insurance or travel insurance. And one of the things this year, I did the haggling. I always do the haggling. Go ring them up. What about the price? Go and look at a comparison site. Particularly look at for the insurer that I'm with to see what they're quoting on a new deal, because you'll always get that. So they will always normally, when you do renewal pack, it'll be higher than the premium they're going to probably give somebody who is a similar circumstance to you anyway. That often happens. You can then easily haggle by ringing up, going, hey, why have you on such and such a comparison site offering this deal, and then they can work it out. But then you can generally try and haggle. This year, my insurer, for whatever reason, was playing hardball. So I voted with my feet and decided to move to a different insurance company. If someone's not going to give you a good deal, then don't stay with them. The problem you have is that, like anybody else, when you're going around these different insurance companies, how do you know what's a good product unless you go through all the T's and C's? Now, Defacto, DEFAQTO. Now, they have a website, defacto.com. Not the best website in the world. It's very clunky. What they do, they're a company that rates products, financial products. And when I was in the city, I used to sit there. They do it on lots of things. It could be on investment products. They do it on insurances. And they have people who go and look at the products themselves, rate different areas of the products, and they come together, provide an overall score, and then they give it a star rating. So if you think of it as probably a poor analogy, but like you go into a 5-star hotel, they have 5-star products, all the way down to 1-star products. And so they rate them, and you can see that a product is generally any good based on the star rating that Defacto give. Now, I'm not plugging a comparison site, but Confused.com, they do show you, if you click through, you can see the Defacto ratings of the individual products that come up on their comparison results. But you can go to Defacto and type in any company, or you can just list insurance companies and see the 5-star, the 4-star, the 3-star products. They do it within companies as well. So if you went to an insurance company and they have a gold, silver, bronze product, then those gold, silver, bronze products will be rated differently by Defacto. So they do, apparently there's 60 experts, 400 hours a day research. All sounds a bit far-fetched to me. 43,000 financial products are rated. And the reason I mention them is years gone by when we used to use them in research for investment products and bits and pieces. It was one of the ways that you'll see power planners, the guys behind the scenes at IFA firms, would used to use them. They had to pay to get access to the detailed reports, but as a consumer, you can just see the star ratings that they give products. So as a quick quality check, it's not the worst thing in the world, because if you base everything you buy purely on price, particularly with insurance, you tend to get what you pay for to a certain extent.
Good stuff. I've heard of the name Defacto, but I'd never really understood what it meant. So yeah, good tip. Good stuff. What we got next?
Right, we got the DIY investment mistakes, but before I do that bit, there was question that again came from last week's episode about national insurance contributions. So a few people wrote in saying, I didn't realise about the low earnings issue, checked with their HR people, etc. Some people are unhelpful. And one of the things that came back is people were saying they didn't understand if they paid enough national insurance contributions. And one particular person was Sarah, who has been a fan of the show for ages. He's even came to one of our meetups, and she asked me about the national insurance contributions. How can she check it? Because she's worried she hasn't been paying enough. Well, you can do it online. There is a means of officially checking. Go to gov.uk/check-national-insurance-record, and you can go on there, and there's a tool where you can check your national insurance history. But enough of that. DIY investment mistakes. Now, this was a piece that appeared in one of the national papers. I think it was the Daily Mail, which I'm going to rattle through now. They had 7 mistakes, 7 things you want to avoid, and one of them was
Neil Woodford.
Do you know what? That is actually partly true. Luckily enough, you can't go into Neil Woodford. So, yeah. Unfortunately, the Daily Mail wasn't the paper saying to avoid Neil Woodford. One of the mistakes is not diversifying. So, putting all your eggs in one basket. Now, that is something that probably is fairly obvious. We've talked about on the podcast before. You want to have a mix and a range of different assets. So, you want to try and not put everything into commercial property or any particular asset of any kind. I would like to add a caveat to that, because I do think it's an issue if you over diversify. And I did some research before for 80/20 investor members, and there is a tendency for people to go and buy loads and loads of funds, for example. We're talking about funds here, where they will buy funds all from the same sector. And so you think, well, yeah, I'm diversifying, it's minimising risk. But what actually happens is the more you buy of the same type of fund from the same sector, the more you end up just buying the same thing, different versions of it, because the funds don't tend to... If you go into a sector, the majority do tend to do the same thing. What you really want is to try and find funds that are doing things differently so they don't all behave in the same way. And if you want a rule of thumb that's based on a lot of research that I did, don't buy more than 3 funds from the same sector. Once you start going above that number, it's particularly over 5, the more you buy, the more you end up just buying more of the same thing. So the counter argument to diversifying is that if you do it too much, it starts to hit returns because you end up just buying. You might just end up having a tracker of some kind. Similarly, if you minimise the number of holdings you have, which a lot of the big fund managers do, that I'm not going to say star fund managers because I don't think they really exist, but if you want to try and outperform, then the fewer holdings you have or the fewer funds you have in a portfolio, the greater that chance is that you will outperform. Also, there's a greater chance you'll underperform because you are betting on fewer horses, as it were. But in my portfolio for 50k, I try not to have more than 10. And that's partly for that reason. You've got to have a level of conviction. A lack of conviction is, if you're going to have no conviction in the portfolio, you are better off just buying and holding a passive tracker of some kind. The next mistake they mention is being too reliant on the UK. Totally agree with that, because there is a tendency for people to only buy UK shares or UK equity funds. They'll always put a bias. The reason why Vanguard have done so well, if you look at the Vanguard Life Strategy funds, the reason they've done so well is because they have a bias towards US equities. And the US equities over the last however many years, if you go back particularly since Donald Trump's been in power, they've rallied strongly. And the US equity market has been the best market to be in, pretty much bar none. I'm talking about the developed world equities over the last few years. So Vanguard has done really well. When US equities underperform, then Vanguard's life strategy funds will start to struggle. Equally, when the pound tumbles, like it has done since the UK referendum back in 2016, then anything that's based overseas, your global equity holdings will get a boost. Doesn't matter if the equities are falling, because the pound has fallen so much. I mean, it fell by about 20%. They get a 20% kicker. So if you'd been in the UK, then you wouldn't have enjoyed that. UK large caps, FTSE 100 type stuff, they get a bit of a kicker from a weak pound, but it's not in the same way, not the same dynamic as if you just hold an asset that's overseas. So don't be over-reliant on the UK, particularly in the face of Brexit, because if the economy tumbles, then your UK holdings will be hit. But it's more than that. It's just about being diversified globally. Over-reliant on any one, whether it's the UK, the US, or emerging markets, is not a good thing. Now, the next tip is tinkering too often. So they say that don't keep tinkering, because if you overtrade and you're constantly buying and selling, then there's multiple transaction costs. Now, I have to slightly disagree with them on this one, because that's a broad statement. There is a line of thinking that buying and holding is the best thing. Go and buy and hold. That you shouldn't tinker. I agree that you don't tinker and panic buy. Emotional investing is a bad thing, because you're always going to make the wrong decision. No matter how good you think you are, you're going to sell at the bottom and buy at the top. And that's the opposite to what you should be doing. No one ever gets it right. They never call the bottom of the market or the top of the market correctly. But having a process that makes you change with a methodical reason, with a objective reasoning, is better than just buying and holding forever. Because look at what happened with Neil Woodford. Buy and hold Neil Woodford forever, then you'd be stuck. But it's also because any given strategy has its day. So there will be different economic cycles that come and go that favour certain types of strategy, defensives, or whether it's going to be cyclicals. So just buying and holding the same thing won't work. If you're going to buy and hold, then by all means buy and hold a tracker. So you're just tracking the market, then that's a strategy. But all the analysis you ever see about passive versus active, always assume that if you just simply buy and hold either one of those, then one will outperform the other. So people who say passive outperform active, they assume that you just stay in one. But why would you? You can change. So I would rather buy something when it's working and sell it when it doesn't. Now, 80/20 Investor is built upon that whole principle, and has been shown, the research shows that it does work. So tinkering too often is an issue, but not tinkering enough. Now, how often is enough? Then I would say once a year. The research I've done shows that doing it once a year is a good sustainable level and actually has an impact on returns. Their next tip is don't panic sell. Yep, agree with that. Don't want to panic. Failing to rebalance is another one. And that is broadly down to the fact that if you end up holding a portfolio, the stuff that's doing really well becomes a bigger portion of your portfolio. The stuff that's doing badly becomes a smaller portion. So if you think of a market where equities rally and say the low risk stuff doesn't rally, then you are actually taking more and more risk. So you might want to rebalance every now and then. Again, when I did the research, how often you should rebalance, you don't need to do it more than a year really. If you're just sitting there buying and holding, then just rebalancing once a year is enough. If you do it too frequently, then you start to actually impact performance. And the reason is because you're never riding any trend. So as soon as something starts doing well, you quickly cut it. You want to ride it a bit. You want to give your portfolio enough time to ride some of that trend before you start to tinker too much. It's slightly different if you're trying to change investments, trying to ride an overall trend. But I'm just talking about if you've got investments that happen to be just riding a trend that's starting to pick up, then that's not a bad thing to let that run slightly. The final mistake, they say, is buying because of hype, which is slightly ironic because nearly all the hype comes from the national press, actually. So, yeah, buying things like Bitcoin and all these things. Woodford was one of them. Buying anything because of hype. It's not just Woodford, but anything because it's a trend is a bad idea.
Often by the time it's come to the hype, you kind of almost missed the boat anyway, haven't you?
Yeah.
It's kind of because of the lag.
Yeah, and I'm surprised. We're going to see more about Bitcoin. At the moment, Bitcoin is in a big rally. It has taken off. It's back above $12,000. And so I'm surprised we're not seeing more of it in the press. By the time the press pick up on this, I mean, it's more than doubled in a month. So we're going to start seeing it. Everybody's going to be talking about it down the pub again. They're all going to be saying why this time is different. We're going to have more of that. So don't just buy something because they're talking about it. You should have been buying it if you thought it was a good idea before everybody else was. I am surprised one of the mistakes they don't mention is overpaying. So overpaying, whether it's on your platform or a fund, will impact your returns over the long term. So it's not just about buying passive trackers. Buying cheap trackers is great, but buying cheaper funds. The impact of charges has been shown. It'll eat away at returns. But if you ignore costs, then it's going to impact what you have at the end. But it's not just about always getting cheapest. There is a sweet spot with investing, which I've done some research for 80/20 investors about what charge. I think I may have covered it on the podcast before. Do go back and look. But I'm not going to reveal it on the podcast because that would be slightly unfair on 80/20 investor members. But you don't have to always go purely on cost. A bit like the insurance products I was talking about earlier. Buying cheap isn't always the best thing to do, but keep costs low. And one final one I'll just mention is investing in what you think will make money rather than what is making money. Now, that might seem a bit of an odd one, but we tend to try and predict the future. So we try and think, well, do you know what? This is going to happen. The dollar's going to be stronger. It's going to be weaker. Pound is going to rally. UK stock market is going to take off. That is something you should try and avoid because no one ever gets it right. If you just look at this current year, no one was predicting the stock market would necessarily rally as much as it would. The best one was treasuries and bonds. Bonds have been a big payer in investing recently. If you bought bonds in October, then you would have made a load of money because people were saying that the bond market was going to collapse. No one should be buying bonds. Only fools would be buying bonds. US Treasury yields were going to go to 4% and whatever it was. Now we're heading back towards historic lows. If you have been in bonds, you've made some good money over the last 6 months and more. And that has almost been as good as being in equities because the equities collapsed and then rallied. So buying what's working rather than just what you think will work is a better strategy. And of course, when I do 80/20 investor, that's what I end up doing. I've been in bonds and treasuries for quite some time. And sometimes it's difficult because you end up making decisions that aren't emotional. Emotionally, you'd be thinking, why am I buying this? But it's about process. So that's the final tip. So that's it for this week, Andy.
Good stuff. So, lovely little insight into investing then, and some nice little tips. If you haven't already, you probably have because you're listening to this podcast and it's probably in your feed. But if you haven't already, do tune in and listen to Damien's Midweek Markets every Wednesday around about 5 o'clock. You get Damien's take on what's happening in the markets each week and what to look out for in the week ahead. And actually, we have got a YouTube channel where you can watch Damien deliver this piece to camera. You can see how good he is on TV and put a face to the name. We'd love you to go over to YouTube and just click that subscribe button, because we've got lots and lots of people that are subscribing, and the more subscribers we get on there, the more people we can reach. So if you're a YouTube fan, go and give us a subscribe, and actually if you click the bell, you'll get notified when there's a new video up as well.
Yeah, and one final thing, don't forget, if you do something mug worthy, to let us know. But there's something exciting relating to mugs. Now keep an eye on our Instagram feed and social media, because there's a new limited edition version of our mugs that are about to come out this week. And if you look at my Twitter profile right now, you're going to get a hint as to what these limited edition mugs are going to look like. There's going to be very few of them, but keep an eye out, because I'm going to tell you how you might be able to get hold of one of these.
Good stuff. So if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. Search us out on Instagram, and please do subscribe to that YouTube channel. It'll really help us reach more viewers. That's it, Damien. We're done. Until next time.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.